certainty about the path of interest rates? And a kind of related question, if you will, could you see raising rates while the committee still judges that the risks are balanced?
So in terms of certainty and providing metrics, we provided a metric or a threshold of 6.5% several years ago and told market participants and the public that we wouldn't consider it appropriate to raise rates as long as the unemployment rate was higher than that level, as long as inflation was well contained. But our policy needs to be data dependent, and we need to respond to incoming data and our assessment of incoming data in terms of where we think the economy is heading and how close we are to our objectives. And the markets, so can we provide certainty? Of course we can't provide certainty because we're not certain what the data will look like and how the economy will evolve. And to achieve our objectives, we need to watch the data, continually reformulate our best guesses, our forecasts of where the economy is going, and respond appropriately. And we can't provide certainty and shouldn't provide certainty because economic developments that will unfold are uncertain. And what market participants should be doing is looking at incoming data just as we are and forming their expectations for where policy will be going and should be going just exactly as we will be doing by attempting to understand economic developments as they unfold. And that is what we're trying to say in the statement, that that's what we will be doing going forward. And we don't want to and don't think it's appropriate at this point to provide calendar-based guidance.
Can I put the second part, the balance of risk? Would you raise rates when risks are balanced?
The risks to what?
If risks are balanced, as they say in the statement, could you be raising rates in that context?
Well, I guess we said the risk to the outlook are balanced. And, I mean, certainly we could raise rates in a situation where the risks are balanced. We need to see, as we've said, we want to see further improvement in the labor market, and we want to feel reasonably confident that the economy is on a trajectory where we will achieve our 2% inflation objective.
Okay, Benya and then Peter.
Benya Applebaum, New York Times. There seems to be an awful lot riding on surveys of inflation expectations, yet those surveys are an imprecise instrument. They don't seem particularly sensitive to the types of changes in inflation that we've seen in recent years. They don't seem to differentiate between, say, 1.5 and 2. The expectations remain stable even through those changes. Could you talk a little bit about why the FOMC has confidence that those measures are accurate reflections of where inflation is likely to go? And whether, the concerns that you've articulated about market-based measures at all correspond to concerns that you may have about survey-based measures?
Well, survey-based measures aren't perfect, and often the mean or even the median of those measures does not line up very well with actual inflation, so they seem to be biased. Nevertheless, they do seem to be useful in predicting actual movements in inflation. And because we think inflation expectations are a determinant of price setting, we need to be looking at the best data that we can, even if it's imperfect, in trying to gauge inflation expectations. And so we do look at survey measures. Now, the fact that survey measures are stable at levels consistent with inflation objectives that a central bank wants to achieve, that's not a guarantee that inflation will over time move to be consistent with those expectations. An example is Japan, I would give you, where for many years the households and businesses expected positive inflation, but there was a consistent undershoot. So this isn't a single metric that is perfect, but it's one of many things we look at. We also look at measures of inflation expectations based on market differentials between nominal and real or TIPS yields. They're also informative, but can move around for reasons pertaining to liquidity in the Treasury market and in the TIPS market, and also because of changing perceptions of inflation risk. So they're not a pure read either, and we want to look at both things and not take away any simple morals.
Okay, Peter and then Jen.
Peter Barnes, Fox Business. Chair Yellen, I wanted to check in again with you on whether or not you see or have any concerns about bubbles out there in the economy, particularly the financial markets, debt and equity markets. And I wanted to refer to your most recent monetary policy report to Congress last month, in which you said overall equity valuations by some conventional measures are somewhat higher than their historical levels. Valuation metrics in some sectors continued to appear stretched relative to historical norms. In the same report last year in July, the report specifically mentioned biotech and social media stocks as being substantially, substantially stretched. Do you still feel that way, and can you comment on bubbles and particularly these sectors?
Well, I don't want to comment on those particular sectors. As we said in the report, overall measures of equity valuations are on the high side, but not outside of historical ranges. In some corporate debt markets, we do see evidence of unusually low spreads, and that's what was referred to in the report. More broadly, we do try to assess potential threats to financial stability. And in addition to looking at asset valuations, we also look at measures of credit growth, of the extent of leverage being used in the economy and in the financial sector, and the extent of maturity transformation, and taking into account a broad range of metrics that bear on financial stability. Our overall assessment at this point is the threats are moderate.
Okay, Jen and then Steve Muffin.
Jen Liberto, Politico. So I want to switch gears a little bit and ask about some of the tension between the Fed and Congress lately, with some lawmakers calling for more transparency and accountability measures. And I wanted to ask to what degree that there might be room for the Fed to consider some of these measures, like maybe a rules-based approach like the Taylor rule, or some of these measures that would change up who has a voting seat on the FOMC. To what degree does that make it more difficult to accomplish your mission?
So I believe the Federal Reserve is already one of the most transparent central banks of any around the globe. We provide an immense amount of information, both financial, about our balance sheet and our monetary policy operations. We have audited financial statements. We publish our balance sheet every week. If you want to know exactly what's in the SOMA portfolio, it's listed on the New York Fed website on a CUSIP by CUSIP basis. I have press conferences. We issue minutes. We have statements that we release right after meetings and transcripts within 5 years. So if you put all that together, we are a transparent central bank. With respect to congressional changes that are under consideration that would influence monetary policy by bringing Congress in to make policy judgments about in real time on our monetary policy decisions. Congress itself decided in 1978 that that was a bad thing to do. that it would lead to poor economic performance, and they carved out this one area of policy reviews of monetary policy decision-making from GAO audits. The GAO looks at everything else that goes on within the Fed. And I think that that is a central bank best practice that global experience shows that giving central banks independence to make monetary policy decisions that they think are in the best interest of the country and consistent with their mandates leads to lower inflation and more stable macroeconomic outcomes. So I feel very strongly about that, but we are accountable to Congress. Of course, we're ready to provide information that Congress needs to evaluate the Fed's decision-making in monetary policy and elsewhere. With respect to monetary policy rules, they can be useful, and I find them useful and long have as a kind of benchmark for thinking about what might be the appropriate stance of policy. But to chain a central bank to follow a simple mathematical rule that fails to take account of many things that are very important in making monetary policy. For example, I was earlier asked about being against the zero lower bound, which is an important special consideration. That would be a very foolish thing to do, and I oppose it. With respect to proposals having to do with voting and the structure of the Fed that you mentioned, a lot of ideas have been mentioned. I would say, for my part, I think the Federal Reserve works well. The system we have was put into place by Congress decades ago. I don't think it's a system that's broken. Of course, Congress can revisit the decisions it's made about the structure of the Fed. There were good reasons for making the decisions that were made about how to structure voting and other things, and I don't think the system is broken. I think it's working well. So I don't see a need for changes, but of course it's up to Congress to review that.
Okay, Steve Musson, then Nancy.
I was wondering whether you could quantify the effect that the stronger dollar has had on economic output so far this year, the extent to which it's sort of acted as its own rate increase, and what sort of obligation you feel, if any, to make life easier for the ECB, Bank of Japan, and the many emerging market countries that are struggling with some of the issues we struggled with not that long ago.
So with respect to the impact of the dollar on the U.S. economy, I don't have a quantitative estimate to offer you, but I certainly expect net exports to serve as a notable drag this year on the outlook. But remember, we have to put that in context. There are a lot of things that affect the U.S. outlook, and while that is serving as a drag on economic growth, overall the committee continues to see sufficient strength, particularly in private spending, that we are expecting above trend growth even so. With respect to our neighbors, we look very carefully at what's happening in the global environment. We realize that our own policies affect performance in the rest of the world, and that performance in other countries has an influence on us. So we spend a good deal of time discussing global developments. It is important for us to keep our own house in order, to put in place the policy that's consistent with the Congress has given us. And I think a strong U.S. economy certainly is something that is good for other countries as well. we have pledged to communicate as clearly as we can about monetary policy, and I am trying